Welcome to the latest Eversheds Sutherland Legal Insights podcast.
Hello, and welcome to Hot Takes, the companion podcast to our series of interviews with leaders and luminaries from the financial services industry, exploring trends and opportunities in global financial markets in 2025. I'm joined today by my colleagues Renée Dailey, partner in our U.S. Finance and Restructuring practice, and Ben Davis, head of private credit in our international business. I'm your host, Sierra Nicholson, global strategy and development lead for financial services. Renée, Ben, welcome. We've just had a listen to our colleague Matthew Allen's conversation with Ed Jolly and Jack Gilbert at PGIM on the, and I'm quoting here, inexorable rise of private credit. Thank you both for being here. I'm excited to hear your hot takes.
Thanks, Sierra. Looking forward to our discussion today.
Thanks, Renée. Good to be on and good to speak to you.
All right, great. So Renée, I'm going to pick up with you straight away on something that Ed mentioned, which is the significant growth of the private placement market. This is a primary focus area of your practice, so I'm wondering if you could go into a bit more detail about what's driving that growth.
Thanks, Sierra. As Ed and Jack both mentioned, while the PGIM team made the comment that private credit is relatively new as a named asset class, the private placement market has been around for years. They mentioned they're involved in the US for doing direct lending for 80 years and in Europe for 40 years. Private placements as a whole have a great market presence. And I think a reason behind that historic presence and frankly the growth is the private placement market is a very attractive market to issuers. First, the nature of private placement debt is long-term and fixed rate. It's particularly well suited to acquisition and project financing. Second, while it's not typically covenant light, like maybe a public bond is, the existence of covenants in private placement documents typically mitigate risk, and therefore it's reflective in the pricing for issuers. So that's attractive from a pricing perspective. And third, from the structure of a private placement, the issuers can gather note holders around a table, seek amendments, have discussions with their lender groups, something not necessarily available in the public debt market, where a more formal consent solicitation is often required. Basically, on the whole, institutional investors in the private placement market, they bring a long-term investor mentality that really can be attractive to company issuers.
Great. Thank you, Renée. Really fulsome answer there. Ben, I'm going to come to you now on a point that Jack made about the rise of new and innovative structures in transactions. And he specifically touched on finding new ways to work with banks and other market participants. So you've been in the European private credit game since day one. Can you share your observations on this? Are you seeing innovative structures enter the deal landscape?
Yeah, that's an interesting question. I've been working in the private credit sector for over 10 years. Credit funds and banks have always needed to find ways to work together. At its simplest, that's the bank providing a revolving credit facility alongside the credit fund's term loan. But over the years, we've seen first out, last out structures where banks also provide a slice of the term loan. Those seem to sort of come in and out of favor a bit. From our perspective, they're still as popular as they have been. We worked on a couple just last year, and we expect that to carry on. But I think what sort of in the nature of private credit is that the private credit funds are seeking to come up with innovative solutions for sponsors and borrowers. It's all driven by what the borrower is particularly looking for. So one area where there's been a lot of development over the years is just around the increased availability of undrawn or delayed draw facilities, where credit funds will help support the rollout or growth of the business over the years, and that really aligns very well with a sponsor's growth strategy. So I think we'll continue to see innovation. I think it's in the nature of the product, and ultimately I think that helps credit funds to find opportunities to deploy capital.
Great. Thank you, Ben. So let's talk about why this is an attractive asset class for investors. Jack shared that there are roughly 250,000 companies between the US and the EU that PGIM would look to service out of their mid-market fund, but that a relatively small percentage of those companies are currently in the private credit market. Ben, I'll stick with you first. What are your views on how the addressable market for private credit might evolve in the year ahead?
Yeah, so I mean, I think Jack is right. There's a huge number of mid-market companies across Europe, across North America. There's also a huge number of large cap companies that are also serviced now by some private credit funds, as particularly in the past 4 years in Europe. And so I think we'll continue to see credit funds lending across the size spectrum. And through from the smaller businesses up to the very largest. Um, I, I think also, you have to look at geographies when you look at when you ask the question about addressable market. We're seeing private credit develop across all across Europe, but there's still some markets in Europe where private credit is used less commonly because it's a better banked market. But I think over time we'll continue to see those banks retreat from the market and private credit funds come in. So I think that will present more opportunities for credit funds and their investors. Um, but I think thirdly, a lot of private credit lending in Europe is focused on lending to private equity backed businesses, whereas actually there's a lot of non-private equity owned businesses, so listed corporates or just sponsorless mid-market companies. And that's certainly a differentiating factor for PGIM, where I think they really do have a really strong track record in lending to those types of businesses as well. So I think all in all, there's a lot of opportunities there for private credit.
Great. Renee, anything to add?
Yeah, I think Ben highlighted really the main answers from the lender side. And while my clients are lenders, I might put my company hat on for a minute and think about how the private credit market is something that should be attractive to more companies than are currently in. And, I refer back to one of Ben's prior comments about really the flexibility and the nimbleness of these structures in private credit. And I really think that those can be attractive to a company addressing very particular needs at the time.
Great. Thank you, Renee. So Ed and Jack both touched on the evolution of private credit post-financial crisis, that a lot of companies coming out of that time, out of that period, realized the need to diversify their capitalization structures. And of course, there's always the backdrop of changing bank regulation. I'd be remiss if we didn't touch on the current trend of legacy financial institutions moving into this space. I think we're all pretty familiar by now with the Citi Apollo join up. I was just reading earlier this week about Goldman's move to create a Capital Solutions Group, which will aim to connect those with investable assets with parties that need financing. So I'd love to get from both of you your thoughts on the banks, trying to get a piece of this market share. Renee, I'll come to you first.
Great. So thanks, Sierra. You mentioned the companies are looking for ways to diversify their capitalization structure. True. So too are legacy financial institutions and other investors are looking to diversify their products. The Citi Apollo join up, as you mentioned, and others, really a sign of innovation as each of the financial institutions are looking for yield. Institutions look at that in different ways, different markets they want to access, different jurisdictions, different types of companies. Really, the search for yield drives innovation. And I think we'll see more of the partnerships as you described the Citi and Apollo.
Great. Ben, what do you think?
Yeah, no, it's a really interesting topic, and maybe just to give a couple of examples of institutions that we've been working with over the recent period. And one of those is Morgan Stanley, and the way that they've approached that is to effectively set up their own private credit fund within their investment management business, and they are, really sort of gaining market share quite quickly and doing well. And on the other hand, you have Lloyds Bank, who midway through last year announced a tie-up with Oaktree, where they would effectively partner up on transactions. And I think both of them show that the banks are sort of remaining in the market and acting really quite robustly in protecting and gaining market share. So I think we'll carry on seeing this this development in the market of both banks and pure credit funds operating in the space and being relevant and competing for deals.
Yeah, I think it's a case of, as Renee made the point, the lenders are looking to diversify their product offerings, and certainly at the end of the day, everybody's going to innovate to meet the needs of the market, right? So plenty of room at the table for everybody, I think. Ben, Renee, thank you so much for your time today. And of course, our thanks to Matthew and Ed and Jack from PGIM for giving us great food for thought and discussion. Tune in all year long for more hot takes.
Thank you for listening to the Eversheds Sutherland Legal Insights podcast.